Welcome to another episode of the Michael Yardney podcast. Now, while most property investors adopt a buy and hold approach, some are looking to become more active. Some are looking to get involved in property renovations and development. So today, I'm joined by Greg Hankinson, Director of Metropole Constructions and an experienced builder, developer and property investor who knows the ins and outs of the building industry, and he's going to give us a builder's take on the do's and don'ts of property renovations and small townhouse development. So whether you're a seasoned investor or just starting out, this episode, my chat with Greg today, should give you some insights into becoming a more active property investor. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Now, today I want to discuss how some property investors end up getting not just good capital growth, but also good cash flow by buying the right property and then manufacturing capital growth, manufacturing cash flow, and I guess depreciation allowances by getting involved in renovations and development. I also want to discuss the traps to watch out for and what to take advantage of. And I'm joined today by Greg Hankinson, Director of Constructions and a veteran of the construction industry. Welcome, Greg.
Thank you, Michael. Nice to be here.
Well, I called you a veteran. People can't see you in this audio-only podcast. You're not a pensioner yet, but you've been in the building industry a while, haven't you?
Well, I don't know how I feel about being called a veteran. I don't feel that old. And I guess if you categorise a veteran in years, I was registered as a builder in 1994, so that's coming on 30 years. If you categorise a veteran by experience, I've renovated over 1,000 properties. We've built over 300 homes. So I guess either way, you could probably describe me as a veteran of the industry these days.
Okay, so you do qualify. Now, I got first involved in renovations in the 1970s. I actually remember the second investment property I bought. I in Bond Street, Caulfield, and I wanted to paint it out. No one actually told me that you've got to leave the windows open and get fresh air coming in. And I was actually very sick after that. And I've actually never picked up a paintbrush ever since. But I've been similarly involved in lots of renovations and got involved in development in the 1980s and been involved in building houses, apartments, townhouses, factories, shops, office buildings. And you and I have been working closely together for a long time. Interestingly, Pam pulled out a photo on the weekend of when you first started. She's going to, I think, embarrass you one day and show you that. But we've been together for a long time, and you've been Director of Metropole Constructions and helping our clients by building their townhouse developments in Melbourne and also homes for them. So I guess the context of our conversation today is we're seeing a lot more interest with investors in getting involved in property renovations and development. And as the cycle moves on, there's all these new educators out there too, Greg, aren't there? They're teaching how to do it. But we've been around long enough, and every now and then we sort of sit down and have a chat and a joke about all those who've fallen by the wayside, people in previous years who said they were experts.
There's a lot of experts that have come and gone. Some are still around. A lot have disappeared. But interestingly, we're still here. And
there's also lots of information out there, but that's not unusual. So our aim is, well, my aim today is actually, I guess, to discuss it with somebody who's been involved in it. Property development and renovations and construction for many years, real-world information, because we are in challenging times for the construction industry. So, Greg, let's start off with what are the options for an investor if they want to add value, if they want to move into the space from being a passive investor to more an active investor?
Sure. There's a number of areas that you can start with. And a great start for a lot of investors in the early days is renovations and refurbishments. Renovation are where a lot of property developers cut their teeth on. They're generally quicker, lower entry levels from a cash point of view and generally a great start. You could also land bank. So land banking is a concept used by large property developers that buy large tracts of land or raw undeveloped land, sometimes called greenfield estates, and they keep their own bank of land for the future, for future development. You could do similar things as the smaller scale developers. For example, you could buy an old house at close to land value. The block of land should be of sufficient size that it has future development potential. This is a great investment strategy because it has the land component for your property that increases in value. And down the track, when you have more funds or the market conditions are right, you could proceed to develop that property into duplexes or townhouses or whatever it is that would suit that site.
Well, that's a strategy you've used over the years. I've used for a long time, and a lot of our clients at Metropole do. So one of the reasons big developers have gone broke with land banking is that it hasn't got any income coming in. They buy farms, they buy sites on the outskirts of the city. Recently, the Victorian government's spoken about introducing a vacant land tax. We're not talking about land, really. We're talking about buying a property, as you said, close to its use-by date, as close to land value as possible, because one day you're going to pull it down, so you don't want to pay extra for something that you're not going to have down the track. But it gives you quite a few options, doesn't it?
That's right. And it's less speculative as well. So there's a little bit more due diligence involved and having a clear process for what the intent of that.
Well, there's an old proven strategy, buy the worst house in the best street, isn't there?
That's right. Exactly right.
Yeah. Okay, what are the other options?
You could also buy a property and add value by getting a development approval or a DA to build some new dwellings or a townhouse development, for example, or apartments. By utilising land for its highest and best use, you're adding considerable value. You could then either sell those properties or you could proceed with the development project yourself and make what we'd call a developer profit.
Sure. So you could sell it with development approval, and it depends upon the stage of the cycle you're at. Sometimes if you've got an approval, builders will pay a premium just so they can get going straight away because you've taken a level of risk out. But in my mind, there's not enough margin in doing that. And I know there are people out there saying, do this and flip it. By the time you've paid all the costs, it doesn't seem to be worthwhile. Having said that, if you add value and then continue with the development yourself, even if you don't do it straight away, because development approvals last, depends which state you're in, for at least 3 years, and then you can extend them again. And I don't think over time development approvals will get easier despite what the government's trying to encourage. So it's a great way of adding a level of value and then proceeding to the next step when you're ready, Greg.
I think so. And the days where and I know you've done this yourself, Michael, you've bought property and sold with development approval. I've done the same, and I've purchased properties with development approval. And while it can be feasible depending on where you're at in the property cycle and the economy, it's more and more difficult these days to make that feasible.
So another option, a continuation of what you said, rather than buy property without development approval and doing it, sometimes it's worth getting a development approval. Now, I know Bryce, who's out in the marketplace all the time looking for development sites for our clients, comes across sites with development approval. The problem is there's usually a reason why the person who's got them is selling them. So be very wary of that, because sometimes they're not feasible. Sometimes they're just not practical. They're not the sort of thing that we'd put on that site.
Yeah, that's exactly right, Michael. And that takes us to the fifth point, and that's you could engage Metropole, for example, to become an armchair developer to help you through that whole project development process.
Sure. Well, we're involved in, I think it's close to 60 developments for clients at the moment. In other words, we help them find the site, one with the due feasibility, one that's able to be developed into usually 2 townhouses or 2 homes, and then run the whole project from concept to completion. And I know your team, our team, Metropole Constructions, gets involved in developing and building a lot of those. I mean, that's an area that you specialise in, isn't it?
It is, yeah, very much so. And we look at it from an investor's point of view. So
it's different to other builders, isn't it?
I guess that's our point of difference to a lot of other building companies that work on margin, and their margin is based on cost. So they're incentivized, if you like, to increase the cost of construction because it's advantageous for them. Whereas we think a little bit differently and look at it from an investment point of view, and it has to be feasible and it has to return some capital value.
Now, I'm sure our listeners have heard that property development can be lucrative. I guess they've also heard a lot of developers go broke, and that's unfortunately been happening a bit more with builders and developers at the moment. So maybe you could start off by discussing some of the benefits of getting involved in property development.
Sure. Savings, rather than buying properties at retail rates. When you become a property developer, you can acquire investments at 15 to 20% below market cost. This is because you don't pay the developer's margin, which is yours to keep, obviously. Pay the agent's commission, GST, marketing, and other costs usually included in the price of buying real estate.
One of those costs, interestingly, is stamp duty. You pay stamp duty on the land, not on the completed project. And that's a considerable saving too, isn't it?
Oh, absolutely. Yeah, more and more so.
Yeah. Okay, other benefits of getting involved in development, Greg?
Profits. At the right time of the property cycle, you can make great profits selling your development projects. It's what most developers do, but the really smart developers don't sell their projects. I know when I first started building, Michael, in the early and mid 90s, I would sell everything. I would buy, develop and sell. Knowing what I know now, I would have been in a much more profitable position if I had have built half as many properties and held them.
How often have we heard that story? So people are looking at this to make a profit, to be a business. Now, again, I don't know your personal circumstances, guys who are listening to this, and girls, but the concept is very few people can make money as a middleman trading development properties, despite what some people out there in the internet are going to tell you. So some of the benefits, though, are you make a profit and that's yours to keep. In other words, you buy it wholesale. It's easier to get finance at the end, isn't it? Because the banks are going to lend you 80% of the end value, which is going to be pretty close to what it cost you anyway. So in some ways, at the end of the project, you're doing it with nothing down. You're borrowing close to 100%. But along the way, you actually need quite a bit of money to get into the development arena, don't you, Greg?
Yeah, you absolutely do. But I guess that talks to the importance of having a really good team around you. And one of the critical components of a great team is having a finance mortgage broker on your side that's development savvy and understands the rules of property investment and property development?
Well, again, it depends upon the size of your development, partly dollar value, also the number of units, and banks treat some developments as just a normal residential loan, a bit like what you do when you buy an investment. But if you've got bigger developments, it's a more commercial loan on very different criteria. So development finance isn't easy to get, and they actually want to know that you can complete it. And having a development project manager like Metropole on your side brings some security to the lenders, because the benefit of this is you actually get leverage, which is one of the benefits of property investment. And then you also get the tax deductions because you have great depreciation benefits. Not a reason to invest, but if all of a sudden you get that, who wouldn't like that icing on the cake, Greg?
Oh, absolutely, for sure. And on top of that, you also get a higher rental return as well. So you're increasing the yield on those properties as well.
Well, you're getting a higher rental return because the tenant doesn't know that you bought them at wholesale. So they're going to pay you the same rent as if you would have paid full price and stamp duty at the retail level. So it means that you get good yields, good depreciation allowance. And at the end, it's interesting how a lot of these, even though the clients of Metropole are borrowing substantial amounts with high leverage, end up being at least cash flow neutral, if not cash flow positive. And I guess there's a level of security if you buy the right property in the right location. It's underpinned by the fact that you've got an investment grade property. And I guess the reason I got involved in this, you have, and as many of our clients have, is because putting all these things together, the compounding effect allows you to grow your portfolio faster and safer than most investors. It allows you to own, I guess, what everyone wants, that concept of a high-growth property that's cheap to own, that's got good rentals and tax benefits. And there's actually very few ways of doing that, despite what some are suggesting. Okay, so we talked a few times about money, how much it would be. What do you need to get involved in development? How much money?
For renovations, some may not need any money down, but you could borrow on the equity already built up in your property and spend, say, $60,000 to increase the value by $85,000, $90,000, plus the increases in rent and depreciation. Say 30, 40, 50% return on your investment for renovations and refurbishments?
Now, I think that's realistic. There are people out there saying you put in $1 and you get $1 back. Those days are long gone, aren't they?
Oh, we'd like them back.
Of course.
You're 100% right. We haven't seen those kind of returns for 5 years, 7 years.
Okay, so we've got to be realistic. And I think that's what we're wanting people to do, to have their eyes wide open. So not a reason not to get involved. We like the BRRRR strategy: buy, renovate, refinance, and redo it all over again, rather than renovate to sell. Okay, so it costs some money to get involved in renovations, not as much, and the bank will sometimes lend you against the increasing value of the building, or maybe just a percentage of the construction, the renovation cost. What about land banking?
Land banking in Brisbane, you can buy a suitable property to land bank for $1 to $1.2 million. It's a little bit more than that in Melbourne.
And if you want to go ahead with the development itself, you're going to need considerably more either serviceability or cash. And that's the sort of thing that if you want to see, is it right for you? Because it's not the right strategy for everybody, why not have a chat with the team at Metropole and talk to one of the property strategists about, is this the sort of thing you should consider? It's not the thing we suggest for beginning investors. You really have to, if you get involved in property development, you've got to cut your teeth on simple buy and hold and maybe renovations first. But okay, having said that, what sort of returns can an investor expect? Now, you've already started to say that about renovations, Greg.
For renovations, I think the expectations these days with the market the way it is, it would be looking at $1.40 to $1.50 back for every dollar spent for cosmetic renovations. And cosmetic renovations are obviously quite different to structural. Wherever possible, particularly with investment properties, we want to try and avoid structural renovations where permits are required, approvals and potentially planning approvals are required. All that does is adds to cost, which takes a lot more time and reduces the profit.
Yeah. Now, again, theoretically, if you do a structural renovation, you should add considerable value, but many people don't get that right. Maybe we can talk about that in a moment with some of the mistakes people make. So with renovations, the margins are, as you just said, with development, the margin on development cost, well, in the old days, we used to want to get 20%. You can't get that nowadays. The cost of land has gone up. The cost of then value of units has gone up also. But the cost of finance, the cost of constructions has gone up. The time frames are longer. So one really has to have a look at, when you do a development, what the development margin could be, and take into account how long and what level of risk. If it's the area where you're certain to be able to get a development approval and complete the development, you'd accept a lower level of risk than when you're in a municipality where you're going to fight the neighbours and it's going to drag on a lot longer, isn't it?
Yeah, I think that's right. And I think that's where you've got to look back and look at what the strategy is and what your investment goals are. And if the view is for a long-term hold, you can get away with a slightly reduced margin because it is a long-term hold.
That makes sense. So again, most developers can't make money turning properties over at the moment, but it's a great way to create equity, to add value rather than selling. As I said, you don't have to pay all those in and out costs that you would normally. So let's start with the bottom of the rung and move up. Why should some people consider getting involved in renovations, Greg?
Well, it's a great, like we said at the start, it's a great entry point. You need less cash down. If you've got an investment property that's somewhat underperforming, or you think you could get a high return, or you want to refinance, adding some value through renovation is a great start.
Now, I know that's one of the things your team at Metropole Construction does. I mean, for me personally, but for a lot of our clients, you're involved in a few renovations at the moment. If you owned a shop, you would do up the shop front. You'd put new stock in. You'd make it look prettier. Same with your property investment. You should treat it as a business. And as you said, sometimes it does get tired, gets past the use by date. I mean, carpets and painting has to be done more frequently. That's not a renovation. But every 15 to 20 years, I think you should consider doing an overhaul of the kitchens, the bathrooms, bringing them up to speed, because you're going to get a wider range of tenants. You're going to get better returns and you're going to have less vacancies. Well, at the moment, no one has vacancies, but it gives you a choice of good tenants, doesn't it?
It's a great mistake that a lot of property investors make, in that it's set and forget. So they've got their tenants in there and then they just forget about it. They see the rent come in every week and that's all done and dusted. Because in fact, it's not actually getting the most out of the property. It's not making the property work as hard for you as it possibly could. You could get a much greater return, much greater equity out of the property if you add some value to it.
So, Greg, what do you look for in a property with renovation potential?
It's a great question, Michael. As we've seen, so many beginners overcapitalise. So location is, obviously everyone talks about location, but it's so true. Location is critical to maximising potential returns for a property.
So you've got to get the right location. There's no use doing up and making a really pretty property in the wrong location.
Yeah, exactly right. You've got to begin with the end in mind. So see what other properties, comparable properties that have been renovated, what they sell for, and work backwards from there. So what's the end value? Subtract the renovation costs, the holding costs, the profit margin, etc., and buy sufficiently well to leave you enough profit margin.
Okay, Greg, now that we've had a bit of a talk about renovations, let's discuss property development. It's a process over a number of years, but I know as somebody who's been involved in development for a long time, there are stages, there are phases that you go through. What are the stages, the sequence of steps that you think about?
Well, initially it's the concept, so coming up with the idea and then refining the idea. Once you've got a refined idea, if you like, it's testing the feasibility on that idea and then negotiating contracts from there. Making a formal commitment, which would include obviously design and planning if that's part of the project, and then construction of the project. After construction, you move into the completion stage, and then the long-term hold and property management, the management of that project.
So it goes through various stages, and initially you've got to, I guess, have a strategy, have a plan, have a reason why, and that's one of the things we do at Metropole. And you've got to make sure that you can not just do the project, but work through it if the cycle changes, if costs go up. So a large part of the initial strategic planning is having the right finance plan, also having the right ownership structure plan, because that could make a difference. And you can't change the ownership once you've signed a contract. Are you going to do it on your own? Are you going to do it with somebody else, a joint venture with family members or friends? And in a recent podcast with Ken Race, we spoke about the importance of not only a joint venture agreement, but also a co-developer agreement to make sure that you're not paying excessive stamp duty or capital gains tax when you separate the units, one for you, one for your friend. By the way, if you're planning to sell your project, there's lots of other things involved as well, GST and BAS. So it's important to get a good team around you who've done this before and work their way through it. You can't just go off and buy a property and hope it's going to work. Greg, I remember years ago, I used to tell a story about Bill, who was a nice client who went out one Saturday morning, it's a true story, to buy a loaf of bread, and he came back with a development site. He got into a lot of trouble with his wife, but I remember him coming to me on Monday very proud and saying, guys, can you help me with this development? And I said, how did you end up buying it? Oh, well, I walked past and the agent said we can put 3 units on it. Interestingly, while if it was a flat site, one could have got 3 units on it, but because of site constraints and problems and a significant slope, Bill could only get 2 units on at best, and all of a sudden what looked like a great opportunity didn't work out. So it's a very different thought process if you're buying a site with development potential. What are some of the things you'd look for, Greg?
It is, Michael. And you touched on something earlier that I just want to back over, and it's the importance of having a strategic plan and a holistic view. The importance, I can't stress enough how important it is to have a complete view of what the project is going to look like, what it is that you're building, and how you're going to get through it from a feasibility point of view, and have enough buffer in place to get you through the highs and lows. It's critically important.
So when we look at a development site, agents will often say development site STCA subject to council approval. You don't believe that, do you?
Well, agents are in the business of selling property, so they don't particularly care once they've sold the property whether you can get your development approval or not.
They don't always know either.
One of the things that we have to look at is the size and dimensions of the site, and is it able to be developed within the local council's zoning and planning guidelines? What you're wanting to build, can it actually be built on that site? Is there any restrictions to the site? Power pole, is there a power pole at the front? Can you get access to
trees?
To the site?
Is a big one, isn't it? In a lot of councils, you'd like to build there, but you can't pull it down an established tree in some areas.
That's right. Is there any easements or covenants or overlays on the site that are going to inhibit the potential for development, or restrict the development to the point where it's just not feasible? You just won't get the returns.
And I think the other thing is you shouldn't take it into account what's happened in the street before. The rules may have changed. So just because you see a development a few doors down the street doesn't mean you can do it today. Now, we've said a few times you've got to get a good team around you. Now, clearly, we want a good builder around you, and we'd love you, if you're considering getting involved in development or building a new home, to consider Greg and his team at Metropole Constructions. In a moment, Greg, I want to actually talk about who else should be on the team, but why would people consider speaking to you about building their next home or their development?
Well, when it comes to development, I think what we talked about earlier is our main point of difference, and that is it's all about the return on investment. So where other builders will work on a margin, and as high a margin as possible, we'll work on a return on investment. Return
on the client's investment, and make sure that they're getting good bang for bucks.
Yeah, sometimes the clients don't actually know what they want. They need to be guided, particularly in the investment space. They need to be guided in so that they don't overcapitalize on their properties, because everybody would like to have their property on the front cover of Bell magazine as the latest and greatest, finishes and the latest cutting edge trends. But that's not what's going to maximize your returns. It's not what's going to leave profits in your pocket.
So you've really got to have that blend, that Goldilocks thing, not too hot, not too cold. It's got to be right. It's got to be attractive, but you also got to know where to spend the money.
That's right. Exactly right.
And that's something that, having done hundreds and hundreds of these, you can advise clients. So even if...
Well, we've made all the mistakes already, Michael.
Haven't we? So I guess my comment would be, sure, we'd love you to work with Metropole to help you become a property developer through our projects division and through Bryce Yardney. But if you already have a home and you're wondering, should you build on it? Would you like a new home? Or you've got some plans and you'd like an opinion of a builder that's been around for a long time, and I guess the safety of somebody who's going to remain around for a long time, I'll leave a link in the show notes and get in contact with Greg Hankinson so you can have a chat about your particular project. Now, I asked a question a moment ago about who else would be on the team other than a good builder. I guess we've already talked about having a strategist at the beginning and a finance strategist. You need your accountant up front to give you some ideas about the right ownership structures, a solicitor for the conveyancing. But you need to get a good team around you, don't you, in the design, the town planning?
You need a good design team, a town planning team. All that's critical to maximising the value of the site and any future development. So an architectural and design team that's savvy with not only property investment but property development is actually critical to the success of a project. And that goes as far as the engineering and civil and structural engineers.
The other things that you can't see, but actually can make a big difference in cost saving, can't they?
Oh, absolutely. A good architect could make or break a development.
Definitely. So I guess what we're saying is a good team saves you money and reduces your risk, especially at the beginning of your stage, because you're going to learn most of what you're going to learn about property development. You're going to make most of the mistakes you're going to make in the first 4 or 5 of your projects. And as Greg said, we made all those mistakes many, many years ago. In fact, in my early days in the 80s, I was carried away by a property boom. I remember doing some sums at the end of a project once and realizing that, in fact, if I wouldn't have done the development of a house I can even remember it, in Mail Street, Brighton, which is a street I go past nowadays. The house has long been pulled down. It was a major structural renovation. I would have actually made just as much, Greg, buying and selling the property and not doing any work because the property boom carried me along. Today, if we made those mistakes, you'd go broke quickly because there isn't that level of capital growth.
Exactly right.
So we've made it sound really easy so far. There must be a catch. Over the years, I've seen many inexperienced property developers and actually quite a few that I thought were smarter than me go broke. So let's discuss some of the risks involved in property development, Greg.
Yeah, for sure. So buying the wrong property, first and foremost, buying the wrong property that's not development ready, and then buying the right property at the wrong price.
It's more important with development than long-term investment, isn't it? You've got to make the sum stack up.
That's right. Yeah, that's right. I mean, we've probably all been to auctions where we've been carried away. We've gone along the ride of emotions and paid more than we should have. It's critically important to...
Because you chase your tail the whole project then, don't you?
Well, that's right. It's where you've got to run your property development like a business instead of with emotions. And if you've got a cap, you've got to stick to your cap. Buying at the wrong time of the property cycle as well. It's something that needs to be factored in. And if you can't hold the property through the turbulent times, then maybe it's not the right sort of property to purchase. Feasibility. It's critically important to be realistic with your feasibility and not kid yourself. It's easily done because you want the project to be successful, to manipulate figures to give you the end result that you want, not what's achievable.
You can make almost any project look viable, can't you?
Oh, absolutely.
Yeah, just leave out this figure, just tweak that one up a bit.
You're delaying the inevitable by fooling yourself with numbers. So you've got to be honest with yourself and work on real figures.
Yeah, yep.
Building the wrong end product or a product that's too expensive and doesn't suit the market demographics. For property investment, whether it's renovation or development, you've got to look at who the end user are. Who's the person that's going to be living in that property, whether you're selling it or whether you're holding it long term. Who's the end user? And then tailor the finishes, the design to suit that market. That's the best way to get the highest return for that property. A downturn in the property market is also a factor that can become a significant risk. So it's understanding where you're at in the property cycle, and again, being honest with yourself and realistic. Interest rates are always a factor. So
the holding costs are significant. People don't often factor that in. In the first year when you've got an older property, you're not going to get good rent because you bought a bit of a rundown property because you're going to pull it down. And then in the second year, when you do the development, there's no income coming in. And interestingly, the rules changed a couple of years ago. And during the time the property's vacant, no income coming in, you can't deduct the interest. So you don't get the benefit of negative gearing during the development of the property. It actually adds to the capital cost of the building, as other capital costs do. So that's something that a lot of people don't understand with construction, and interest rate changes can make a significant difference. The other one, I guess, is the increased cost of construction. And that's been in the news continuously. Construction costs have skyrocketed in the last couple of years, haven't they?
It's not going to be news to anybody unless you've been living under a rock. Construction costs have gone up. We're estimating that about 35% over the last couple of years. While we're seeing that plateau a little bit now, there's still some isolated increases in various with various materials. But for the most part, that's slowed down. The reality is, Michael, it's just reset the benchmark. So people talk about construction costs coming back and settling. I and other industry experts don't expect that to happen. It's just reset the benchmark.
No. So in other words, they're not going to grow as much. And the latest figures showed that the August figures from the Australian Bureau of Statistics that construction costs didn't rise a lot in the last quarter. But having said that, they're not going to come down. Builders and tradespeople aren't going to accept less. There's not enough workers around, and material costs is not going to come down. So I guess what we talked about is some of the risks. That's not going to be as big a risk in the next year or two as it was over the last couple of years, but it's still something you've got to factor in. You've got to factor in the supply and demand at the end of your project. And Greg, things always go wrong. There's always unexpected things. We allow a contingency. Often the unexpected things happen at the beginning of the project, underground, when you suddenly pull down the house and find things, that soil conditions or other problems you're not aware of. But during the project, you can also have disputes with your builders, with tradespeople. So there's always delays along the way, aren't there?
There is. Delays are somewhat inevitable. You need to factor that in when you're signing building contracts or when you're negotiating with particular trades or your builder. It's about being realistic and honest.
Yeah.
And there's some unforeseen issues that can come up through construction that are just inevitable. It's not because anybody's done anything wrong, or it's just the nature of construction, if you like.
Sure. So while property development is something you should consider if you've got the funds and if you've already ready to move to the next level after being a more passive investor, I've encountered all the problems with my own developments. I know you have, Greg, and we have with clients after doing so many developments over the years. The common reasons I've seen people fail in property development, and that's why I'm not trying to discourage people. I'm saying be careful that you've looked at everything and have a good team around you. Is they've paid too much money for the property to start with. They haven't done an accurate feasibility or a feasibility at all. They've become overconfident after doing one or two developments. How often have we seen that, Greg? And then all of a sudden they accept a lower profit margin, take on a more risky project. They've done one, they've done two, and then all of a sudden they go broke.
That's right, yeah.
Or they've timed their development poorly if they're planning to sell it, completing the cycle. The project at the slump stage of the cycle can have bad results at the end because end values aren't going to be what you were hoping for. Having said that, if you're planning to hold them, that shouldn't be a problem. So I think what's happened is people get into property development without understanding the rules of the game. They don't know what they don't know, so they get caught out. So I guess one of the aims of this podcast today with you, Greg, was to allow listeners who are considering getting in to property development, do it with their eyes wide open. I know currently there are people saying build 4, sell 3, keep 1. It doesn't work that way. The government, the tax man doesn't allow you to isolate your one and not pay a profit on that one, but make a loss on the others. Or others are saying you can get into property with no money down and avoid the banks, use options. Boy, the option story's been around for a long time. I haven't seen anybody other than the educators make money out of that one.
Yeah, that's right. But I mean, the reality is, though, Michael, if it was easy, everybody would be doing it. If it was risk-free, everybody would be doing it. And they're not. So it's critically important, obviously, to get a great team around you and tap into the experience of people that have been there, done it, made the mistakes like you and I have, Michael, and are still doing it now.
So I guess start small, get a good team around you, know the right questions to ask, educate yourself, but educate yourself with people who've done it before. And why not consider using the team at Metropole Projects as your project manager? I wouldn't be using architects as project managers. Builders hate working with architects as project managers. But I think now's a good time to consider getting involved in property development. Sure, building costs have risen, but they're coming under control. Finance is challenging, so you need to get the right people around you. And again, a shameless plug, get the right builder around you. So Greg, if somebody's interested in just having a chat about building, whether it's their home, a renovation or a development, would you be happy to have a chat with them?
Yeah, absolutely. I'd be happy to have a chat to anybody that's considering development, either construction or renovation of any investment properties or new home development or townhouse developments.
Sure. I'll leave a link in the show notes so people can click on that and get in contact with you.
Thanks, Michael.
So clearly, Metropole Constructions specialises in construction of townhouses and homes in Melbourne, but has had the experience, many decades of experience for renovations as well. So thank you very much for your time, Greg. You and I speak every day as business partners anyway, or almost every couple of days anyway, but it's good to have you on the podcast again.
Thanks, Michael. Always great chatting with you.
I hope you enjoyed my chat with Greg Hankinson, and if you didn't, whet your appetite about getting involved in property development or renovations, I've got something I want to share with you. But before I do, why not, if you don't already subscribe to the show, subscribe now. If you already do, thank you, and I appreciate you coming back. But I know lots of people listen to this and don't follow or subscribe, so whichever podcast app you're on, just follow us so that twice a week you're going to get our regular updates. And as a way of saying thank you, if you haven't already picked up your bonuses, why not go to podcastbonus.com.au, whether you subscribed or not. It's my gift to you, just my way of saying thank you. I'll leave a link in the show notes, podcastbonus.com.au. Now, with my conversation with Greg, I really explained the concept of getting involved in property development and renovations. But property development is what we've been helping clients with for well over 30 years. So if you're considering becoming a property developer, but you don't really know but you know you want to do more, but you don't really know how to, why not allow our efficient construction project management team help you maximize the return on your investment properties? We can help you unlock that trapped asset in your land or any old property that you got, or we can actually help you find the right site to become a developer, the right development site. Most properties are not development sites. Either way, we can take care of all the time-consuming and difficult tasks to ensure you get that profitable project you want with the minimum of fuss. As your project manager, Metropole helps you find the site in the right location. But, of course, we always start by helping you put a plan together, a strategic plan to make sure it's the right thing for you. We evaluate town planning and development issues. We do detailed feasibility studies. And we assist with the negotiation, purchasing the land, obtaining the development approvals, preparing working drawings, obtaining the building quotes, appointing a builder, organising the surveying, the subdivision. All these things you're not as familiar with. But you can learn a lot about this in your first couple of projects, aren't you? We'll even point you in the right direction of the right finance brokers who understand about development finance, because that's very, very different to just buy and hold investments. We keep you updated all along the way so you can become what I call an armchair developer. Go to metropole.com.au, leave us your details, and we'd love to help you become an armchair developer. And if you're not ready for that yet, we will tell you. And again, we're still keen to help you become a regular, a less active property investor, and wait for the right time to move up to the next level.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
I've got a slightly longer mindset message with you, but I get a lot of great feedback on these sessions, so I hope you're going to benefit from it as well, because the psychology of success is a critical part of success in all areas of your life, not just property investment. So today I'd like to explain to you why you should enjoy the moment. And I read that Abraham Lincoln said, in the end, it's not the years in your life that count, but the life in your years. Look, we're living in a society that's constantly reminding us to save for the future, to be financially responsible, to prepare for the unknown. We're told to stash away cash, our hard-earned money, to save the finest china for special occasions, to preserve the best wine for later. I know Pam's got a whole set of wine down in the cellar that she's keeping for I don't know what. And yes, we've actually got that great china set that we got for our wedding 26 years ago. It's only brought out a couple of times. But if you've been following my writings or listening to my podcast, you know I often talk about the importance of delayed gratification. You know how tempting it is to instantly indulge in your desires, right? But here's the kicker. Holding off on those immediate rewards can bring about even greater benefits in the long run. First of all, it teaches us patience. It teaches us self-control. Learning to manage our urges helps us in various elements of our life. Be it sticking to a diet, maintaining a budget, focusing on long-term asset growth through your property investment. Plus, it adds a layer of appreciation to our achievement. When we've waited for something for a long time, when we've worked hard for something, we usually value it more. But what if the best time, the right time, was now? I found that every year as the calendar flips over to the next year, the beginning of a new year, and that's not far away, we make resolutions. They often involve denying ourselves immediate pleasures for the sake of some future benefit. We vow to eat healthier, exercise more, save money, quit bad habits. But what if our most transformative resolution was to do the opposite? What if we decided to indulge in life pleasures now instead of postponing them for an unspecified future? The most enlightening New Year's resolution I ever heard was to start relishing all the most cherished things instead of saving every small pleasure for a nebulous future. Now, this paradigm shift is not about reckless spending. It's not about squandering resources, but about releasing the mentality of scarcity and embracing the joy of the present. Now, having done all that and having discussed this, I'm not a big wine drinker, but I know when Pam and I were discussing about this, she changed things in and she's now drinking the good wine that she saved for a future occasion. We started lighting those good candles that were sitting there waiting for a special time. I started wearing expensive aftershave, enjoying things. See, it's easy to recognise the typical sort of person who's too loose with money. We see them as reckless, spending beyond their means, accumulating debt. However, there's a less recognised but equally limiting type of personality, the person who isn't living their best life because they aren't spending enough. That's just as good a financial discipline, right? Well, not necessarily. While having a healthy savings account, having some buffers there, investing is certainly better than drowning in debt. Being overly frugal can also be problematic. It's not about money per se, it's about denying ourselves the pleasures and experiences that we can comfortably afford. Often this behaviour stems from a place of fear, a place of scarcity, a belief that there isn't enough, there won't be enough in the future. So people keep scrimping, people keep saving. I guess you've got to understand what is enough, when is enough, when can you now start enjoying it. Now this behaviour goes beyond finances. It permeates into all pleasant things and experiences. Psychologists refer to this as deferred happiness syndrome, the tendency to put off doing things that make us happy until a later date. But that later date never comes, so some people never get around to being happy. And this tendency is deeply ingrained in our evolutionary biology. The organisms that have over-prepared and deferred immediate pleasure were the ones that survived. However, in our modern world, this instinctive drive can lead to us to oversave, overhoard, and miss out on the joy of the present. In fact, a while ago, I did a podcast with an American author, which was to work out when is enough. How do you know when you've had enough? So I think it's crucial to remember that while survival is important, it's not the only goal of life. We must also take time for happiness. Happiness today because it's both an end in itself and a vital source of nourishment. It's what makes life truly worth living. Not only is happiness an end in itself, but it nourishes us in profound ways. It adds colour to our life, fuel to our creativity. It enhances our resilience. So my suggestion to you in this mindset message is, instead of deferring our happiness, it's worth asking ourselves, how can I bring more joy into my life right now in a way that aligns with my long-term financial goals? Of course, I'm not advocating reckless spending or squandering your savings in a single spree. I believe it's important to spend less than you earn, save the balance, invest your money, build an asset base. I know the importance of delayed gratification. I talk about it so often in these sessions. If you do the easy things now, you're going to have a more difficult life later. If you do the hard things now, you'll have an easier life later. But it's also worth reflecting on the thought that, are you deferring your happiness too much? And if the answer is yes, you can invite more joy into your life right now in a way that aligns with your long-term financial goals. I don't know, maybe it's using those good bath crystals you've been saving for a special occasion. Maybe it's breaking up that fresh notebook that you've been keeping pristine there, or sipping that nice bottle of wine you've been storing. These small indulgences can serve as special potent reminders that life is happening right now, not in some distant future. Unfortunately, having seen a few people go through real health challenges, I guess I've realised that life is not a rehearsal. It's happening right now, and it's up to us to make the most of it. I know there's a saying that good things come to those who wait, but in my mind, it's all about balance. So my suggestion to you is to strive to live fully, savouring each moment, because as the saying goes, life is for living. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?